Hello, welcome back to this week's episode of Closed by Mo. My name is Mohammed. I'm hopefully your favorite YouTube host on most things real estate. I'm also a real estate broker and an investor based out of New York City. In this week's episode, we're going to talk about the different valuation models when it comes to commercial real estate. And by no means is this like an exhaustive list. This is just 6 different ways that you can approach and value commercial real estate. Some of these might work for your market, some of these might not work for your market or your different asset class. Commercial real estate can be very subjective at times, but I hope you're able to learn a couple of things from this video. So without further ado, let's jump right into this. Now, I want to begin the second half of this video by saying that there is no real silver bullet when it comes to commercial real estate property valuation modeling because it's just so subjective, right? A single type of commercial property in one particular neighborhood might sell for a completely different price than the similar property in another neighborhood, or maybe even a nicer property in like a worse area, whatever it is, right? There's just so many factors when it comes to commercial real estate that one true valuation model just does not exist, as it may happen for residential real estate. In the commercial real estate world, it's very much the wild, wild west, and that's why we have so many different valuation models, out of which 6 of them is what I'm going to be talking about today, even though there's plenty more. The reason I say that is because I don't want you to feel like, hey, these are the different models that we can use, and this is what we're going to stick to. There is a certain, I would say, factor of subjectiveness attached to each of these models because different investors are going to value different things differently, right? The reason I say that is because, one investor might approach a property with a specific, let's say, valuation model, let's say cost approach, whatever it is, and another investor might do the exact same thing, but they might inherently place different values on their cost of materials or even like the overall trend of a specific neighborhood and how much they're willing to pay for it, right? So there's more than one way to chop the onion, so to speak. The first way, as I've already sort of alluded to, is the cost approach. Now, the cost approach, in reality, I've actually never used this. Never in valuation properties, never in looking at any of the broker pro formas that I've seen in New York City and Long Island have I ever seen the cost approach applied. That's because the cost approach is something that is a little bit, I would say, out of norm in terms for New York City and Long Island. I understand what cost approach is. Cost approach is basically when you're looking at a property and you're like, hey, it's very hard for me to find comps in this area or comps in the region within the last X amount of months or years, whatever it is, time frame that you're looking at. So you say, okay, if I were to demolish this building and build it the exact same from the ground up, the exact same everything, how much would it cost me to build that? And then that's the valuation of the property that you're going to basically be using, which I think might be more common when there's not enough comps to go around or there's not enough similarities. So basically more in, I would say, rural areas where there's not enough other price discovery events happening. That might be the way to go about it, and that is the cost approach. Now, the second way to value commercial property is what we call the sales comparison approach, or the comps that I say a lot in my videos, as well as for residential and commercial, because this is very common. Basically, you're looking at a property and you're trying to find other similar properties that have sold within a specific time frame and saying, okay, if all these other properties are very similar to mine and they're selling for around $1 million each, then my property is going to be worth $1 million at the very minimum, and maybe plus or minus depending on any extra things that the property may or may not have, which goes back to why there's always a subjective factor to it, because the right investor or a different investor might look at a property that has or doesn't have one or a few things that other similar properties have and then give a value that's above or below what the rest of the comps are showing. That's why it's so subjective. The third is probably one of the more common ways that I see is called the income capitalization approach. Very similar to what you'll probably have seen me in my previous videos. Basically, in commercial real estate, you look at the income potential or the income generating potential of that specific property before giving it a value. And what you're trying to figure out is, okay, how much income is currently being generated from this property, and what is the present value of all those future cash flow streams or future cash infusions or income that you're going to be getting. This is very common, especially when you start to see properties, or if you do see any broker pro formas where they're going to be looking at the cap rate as well. So basically what they're showing is, hey, look, you have this property here. Here's the net operating income divided by what we're seeing in the market cap. This is what we think the property valuation should be. And then you're basically, deriving your valuations from that. Is this a perfect methodology? Of course not, because remember, in commercial real estate, there's a bit of scientificness to it and there's a bit of unscientificness to it too. I don't know if those are real words, but you're basically combining the two because you want to be able to find a yield or a cap rate that's what you're seeing in the area or seeing in the region for other asset classes, and then apply that to the income of the property itself, and then derive your valuation from that. So obviously there's going to be a little bit of subjectiveness to it depending on which cap rate you're sort of landing on, what you're seeing other properties transacting on. That's why it's so important to take a look at things from a very holistic approach, which also includes like cost approach, sales comps, income approach, all these different things that are rolled into one, or at least multiple ways before you go ahead and execute on a deal. The fourth that I haven't really seen too often is the value per gross rent multiplier. Now, the gross rent multiplier is a valuation method that basically compares a property's valuation or potential valuation by taking the property price and dividing it by the gross rent or the gross income that you'd be generating from the property. So in this particular example, let's say you have a $500,000 property, $500,000, and you know that the gross rent is going to be around $70,000 or so every single year. This is gross rent, so you're not accounting for any expenses or anything. Your gross rent multiplier would be right around that 7.14, I believe. So that's why I'm looking off the screen to look at my calculations. Is that a good deal? Is that a bad deal? I don't know. You tell me. Depends on what your underwriting criteria is. For some people, that might not be the best deal. For other people, it might be an amazing deal. Some people might want a higher ratio or a lower ratio depending on what their underwriting criteria is. But it's just one of the very many methods to quickly underwrite on a deal or quickly look at a deal and say, hey, this is what works for me. Let's keep doing our due diligence. Or hey, this doesn't work for me. Let's stop doing our due diligence. The fifth way that I've seen other investors actually value commercial properties is value per door. What I've seen this happen with a lot is either hotels or like multifamily properties. Value per door is basically where you take the asking price or the valuation of a property divided by the overall number of units or the overall number of doors in that particular property, and then that'll give you an overall valuation per door of what you're actually paying for all those units put together. So let's say, for example, you have a $4 million price tag on a 20-unit apartment building or 20-unit hotel, whatever it is. You're effectively going to be paying $200,000 per door for that entire property. Now, whether this $200,000 is a good deal or it's a bad deal depends entirely on what how you're looking at things. That's why it's so important to look at things from a very holistic perspective, because that $200,000 per door might be a lot or it might be very little, and the only way you'll know that is if you look at other properties that have traded very similarly, or maybe that you've bought or sold in the past, to give you an idea of whether or not that $200,000 per door is actually a good deal or bad deal or whatever it is for you in particular, for you as an individual investor or as an institutional investor. The sixth and last valuation model that I'm going to be talking about in this video is the cost per rentable square foot. Now, cost per rentable square foot, I've seen this apply more to like commercial, and of course commercial, I mean like office property. Basically, if like a building has $10,000 rentable square footage and the average cost to rent it is like $12 or let's say $12 per square foot, and the purchase price is $1.7 million. I'm looking at my example. That's what I'm looking off screen. So your gross rental yield, if the purchase price is 1.7 million with 10,000 square feet and it's $12 per square foot, is around 7% gross rental yield. You're getting that number by taking the $12, multiplying by 10,000 square feet, and then dividing the purchase price by that specific number. That'll give you an idea of how much your overall yield or return will be. Now, you might know that, hey, you know what, it's being sold for $12 per square foot a year. Then I might be able to add some value to it and raise that from $12 to $14 per square foot annually, and that might give you a valuation of 1.9 or closer to 2 million. So those are the things that you can typically use to look at things from a cost per rentable square footage. Again, I want to clarify, these are all different valuation methods. There's no one right way to look at it because it depends on property to property, investor to investor, geography to geography. I just know that in the New York City and Long Island market, I'm seeing more people use the income capitalization approach as well as the cost per rentable square footage, especially when it comes to like office spaces or even larger like industrial spaces as well, like warehouses, things like that. Again, there is a mixture of scientific and unscientific method when it comes to commercial real estate valuations. So I hope you're able to take away something from this video, because I know I had a lot of fun learning about this and building out these examples to teach you guys a little bit more about it. I'll catch you guys next week. Let me know if you have any questions, comments, concerns, whatever it is. All my information is below. I also read through all my comments, texts, DMs, everything that you sent me, guys. Thank you so much. I'll see you guys next week. Bye-bye.